Particulars of S Limited, which was purchased by H Limited on 31st August 2011, are as under. Balance in profit and loss account, general reserve given for 1st April 2011 and 31st March 2012. You are informed that there was an abnormal loss of rupees 10,000 on 30/9/2012. This is actually 30/9/2011. An abnormal gain of rupees 20,000 on 30/6/2011. You are required to prepare analysis of profits assuming H Limited holds 70% of share capital of S Limited. Now it's always easy if we can just point out the series of events, right? So you are given the profits on 1/4/2011 and you are also given the profits on 31/3/2012. You are informed that there was an abnormal loss of 10,000 on 30th September 2011. So somewhere here, there is an abnormal loss. This date is 30/9/2011. Right? An abnormal gain of 20,000 on 30th June 2011. So there is an abnormal gain. This is 36/2011 and the amount is 20,000 for the gain and 10,000 for the loss. When did the acquisition happen? The acquisition happened on 31st August 2011. 31st August is going to lie somewhere in the middle over here. Acquisition date. Right? So this acquisition date marked in red is the danger line. Anything before this is a capital profit or a event which has to be adjusted in capital profits. Anything which happens after this date is a revenue profit or a revenue profit event to be adjusted in the revenue numbers. Right? Let us see how we will prepare our analysis of profit. Analysis of profit. So you have profit and loss account, you have general reserve account, right? Both these accounts have opening balances, so there will be capital profits, there will be revenue profits. If we see the balance of general reserve, the opening and closing is the same, so there cannot be any revenue general reserve, so we will just have the total number. So 130 and 20, 30 and 20. 30,000, 20,000, 130, 20, right? So whatever profits are earned during the year between 1/4/2011 and total is given on 31/3/2012. The acquisition date is 31/8/2011, which means there are 5 months during the current year which are pre-acquisition and 7 months which are post-acquisition. So let's say during the year how much profit did we make? 130 minus 30 or 1 lakh. Included in this 1 lakh is the impact of an abnormal gain and an abnormal loss. Right? Now as I told you, because these events are date specific, so we need to adjust them accordingly either in the capital profits or the revenue profits as the case may be. Right? So abnormal loss 10,000. How will you deal with this? Abnormal loss. This must have been reduced to arrive at this profit, so we will increase these profits to nullify the impact of abnormal loss. Similarly, abnormal gain would have gone ahead and increased these profits. To normalize them, we will reduce the abnormal loss, the amount being 20,000. Right? adding or subtracting this, 30 plus 20 gives you 50. 100 plus 10, 110 minus 20 gives you 90. So 90,000 would have been the profits which I would have earned if the impact of abnormal loss and abnormal gain was not there. But out of this 90,000, as I said, 5 months profit are pre, 7 months are post. So we will carry out a time adjustment of profit. So 90,000 into 5 by 12 is what belongs to the pre-acquisition profits, right? Let's see how much does that amounts to. 90,000 into 5 is equal to this divided by 12, 37,500. This gets reduced from here and added here, right? So what do I get here? I get 87,500. And here 90 minus 37 will give you 52,500. After doing time adjustment, we need to now provide for abnormal loss and abnormal gain. The beauty of this diagram is that you can very easily see which period does these belong to. So abnormal loss, where is it falling? It is falling on the right side of the red line, which represents the acquisition date, right? Or the post-acquisition profits. So we will reduce 10,000, which is the abnormal loss from post-acquisition period. Abnormal gain. Again, where does it lie? It lies on the left side, which means it is pre-profit. Left is pre, right is post. So add 20,000 here. You get 107,500 here, and you get 42,500 here. We have holding, minority. 70% is the stake which is given in this particular question. So that means 30% goes to the minority, right? Let's have the calculator, please. 107,500 into 0.7 is equal to 75,250. Right? If you reduce this 107,500, 32,250. Similarly, for 42,500, you will get 12,750 here. Right? Let's see this. 42,500 into 0.3 minus 42,500, 29,750. So we have allocated the profits between pre and post and between the minority and the holding in this particular question, right?